Hi, we are starting our coffee with clients today here with our interview with Keith Gangle, portfolio manager for Gradient Investments. Keith, we want to welcome you to our coffee with clients. We've been in the State College office here a few times having these events. But this is your first time, so we want to welcome you. And could you tell our clients a little bit about yourself and your role at Gradient Investments?
Sure. I'm Keith Gangle. I'm one of the portfolio managers at Gradient. I've been here for 6 years. I manage several of our different portfolios, but the two bigger ones are the Core Select, which looks like the U.S. index S&P 500. Instead of owning all 500 names, that portfolio is going to own 50 to 80 names. We're active portfolio managers here, which means we're buying and selecting stocks. I may own Apple, I may own Google, all these different names. I may own Tesla, I may not. That's what we mean by actively manage. I'm selecting stocks within the portfolio. G33 is another one of the portfolios I manage. That's an all growth portfolio. Again, so that's my background. I've been doing this for almost 30 years. I worked with Mike Binger, our president, who I think has done a couple of your interviews here as well. I worked with him for 15 years at another large mutual fund company. So again, I got about 30 years of experience. And you could tell by the gray beard, the market's been a little bit tough. So it's starting to age me a little bit. But the good thing is I worry about that. So you and your clients don't have to worry about it.
Great. And we've had Mike on here a few times, so our clients who have been to a few of these events have seen his face and know who you're talking about.
Yes.
Leading into that, I mean, we got to spend a few days with you last month at the Gradient Lead Advisor Forum. Bruce Bohr and I were out there, so it was nice to spend some time with you and the other portfolio managers. You guys had a lot of great, phenomenal speakers out there from leading investment firms such as J.P. Morgan and Goldman Sachs. So we'd like to get your take on the key topics that were discussed and that you feel could have the greatest impact on our clients.
Yeah, it was great seeing you guys out there. I mean, it's fantastic working with you guys. We had our best lineup. We've been doing it, I think, for about 12 years. I think that was our 12th one. We had a little bit of break there with COVID, so everybody's not sure if it was 12 or 13, but I think it was 12. This was by far our best lineup, and you mentioned it. We had a Goldman person there. We had a J.P. Morgan person there. We had a. I'll start with some of the highlights. Some of our big hitters was Jeff Sherman from Double Line. He's our fixed income strategist. Double Line is basically the bond kings on the street. It's Jeff Gunlock, who's the CEO of the company and founder, working with Jeff Sherman's his right hand man, the number two guy. So we get the number two guy. That's very impressive. And we talked about interest rates. What the Fed just got done cutting 50 basis points. I think we'll get that here in a little bit. But he actually gave some insight because it just happened right before he actually came on stage. A couple of days later. So it was good timing to actually get him and his thoughts on what's going to happen. He was predicting, which is generally in line with how we're thinking about the world as well. Obviously, the Fed's in the cutting mode. They're going to start interest rates is going to be yields are going to be starting to come down again now. So, which again, that's going to for you savers that had your money in some safer money assets, that's going to now you have to stretch a little bit to can and maintain those same type of yields. So just think yields are going to start coming down. And then we also had a strategist, Brian Belsky, who's from BMO. He's wildly bullish. He's been wildly bullish for quite a while. And again, we're bullish as well, but we're probably a little more tame than where he's at now. And he's calling for the S&P 500 right now is about 5,700. He's calling for a target of 6,100 by year end, which is a pretty aggressive. The markets are up about 22%, 23%. Depends on what day we're looking at here. About 23% per year to date. So that's a pretty good start. After last year, we're up 25%. So he's even more bullish. So the strategists are bullish. The markets are going to continue. We're in a secular bull market, and we agree with that. We think it's going to be a little more of a churning, and we've had nice, a year and 9 months. That's a nice, almost 25% and 22%. That's a pretty big rally. I just want the clients to kind of temper their expectations going forward. There's a lot of stuff we can talk about within the markets as well.
I think everyone lost a year with COVID, so I can understand how that could be confusing for you
Yeah.
guys trying to count that.
Yep.
And I mean, Brian, we've seen Brian now a couple of times, and he's a great speaker. So we always enjoy when he's on your menu there.
Yeah, he's
Uh,
been here, I think, 11 times, so he's fantastic. He's very opinionated, and actually a lot of stocks he picks and the trends he likes are stocks that I actually own in the Core Select as well. So I agree with him with a lot of his picking style. I just dampen my enthusiasm a little bit from where Brian, but he's a great speaker and entertainment, and all the advisors love hearing him. And clients, if you see him on TV, we have him every year. He's a great guy to hang out with.
Great. And you touched there about Jeff with double line and the Fed rate cuts, and that's one of the things I know is on a lot of our clients' mind. We know they cut rates last month,
Yep.
and it looks like they're going to continue to do so. So, what is your take on that action, and how do you think it's going to affect the markets, both fixed income and on the equity side?
Yeah, that's a great question. And unfortunately, I've been doing this for almost 30 years. We don't like to talk about the Fed as much. When they're in the background, that's a better thing, right? The reason they came to the forefront, it was because of inflation back in 2020, right? They pumped a lot of money into the system. Inflation ran wild. So what did the Fed do? They came in and started raising the Fed funds rate. So when you hear them about raising Fed funds rate, and the reason they do that is to slow the overall economy rate. And so they pumped it all the way up from a 0% Fed fund policy all the way to like 5.25. So that was a big, massive increase. That was obviously inflation was running rampant. If you go back to 2022, we had 9.1% inflation. So that's coming down. So now the point being is that the Fed is going from a tightening cycle to slow the overall economy to now we're going to actually start easing. And that's what actually happened, in September. They cut 50 basis points. That's the first cut we've seen since COVID, right? When the COVID hit, they actually started cutting the rates back down to zero. And so we quickly rolls the rates back up to 5.25, and now we just got a 50 basis point cut. So now the next question is, what do we think is going to happen going forward, and what impact is for the stock market and for the bond market? We think the Fed's going to continue to cut, but we think it should be more measured. We thought maybe a 25 basis point was due last month, but they call it like doing a little bit of a catch up as to why they did 50 basis points, because they're worried about the economy slowing as well, because the Fed's got a dual mandate. They want full employment and the stable pricing, which means they want inflation around 2%, and they want to keep unemployment at a reasonable level, which is anywhere around that 4 or 5%. And right now unemployment's at 4.1%. So it's kind of a balancing act, right? It sounds great, to cut interest rates really good, because when rates do come down, that's generally a tailwind for the stock market. That's ultimately where your question was. So as rates come down, we've seen the market since the Fed's cut, it's had a nice little increase as well. I think that's due to the Fed kind of easing, making money a little bit more cheaper for consumers, right? We always talk about double-edged sword. So if you're a consumer buying something, the Fed funds rate, it's a short term where you're getting money, whether it's a CD, or stable value portfolio. These money market funds are based on where the Fed funds rate is. So when they cut, those rates are going to come down, which is kind of, if you have money, it's not a good thing. But if you're borrowing, your credit card rate should start going down. Your car loan should start going down. And eventually that'll also get to the housing market on your 15-year and your 30-year mortgage. That may take a little bit while, but so that's what rates do. And when rates come down, that's good for the stock market, because that pushes people back in the economy. They spend, which is good for the stock market. Now, on the bond side of things, I just touched on the short term stuff like CDs, your money markets, expect to earn less interest rates. So right, they're at 5.25. They cut 50 basis points. That means they're at 4.75. Still not bad when you compare a few years ago. We're at about zero. So that's kind of what the impact for the stock market and interest rates.
And then on the bond market, as interest rates are dropping, we typically see prices rise on existing
Yep.
bonds, correct?
Yes, exactly. So bonds have the inverse relationship, right? When yields come down, bond prices go up. So as these yields come down with the Fed cutting, expect your bond price to go up. And that's why a lot of people are very comfortable being in bonds as well, right? Because your yields, you're locking in, a decent rate right now. And as yields come down, you also get the appreciation of the bonds. Now, that's exactly the opposite of what happened in 2022. That was a terrible stock market. Markets were down 20%. The bond market was actually down 13%. And the reason the bond market was down that so much was because back to the Fed, when they raised rates so aggressively, right? Rates went up, bond prices went down. So that was down 13%. So that's a bad situation. Now we're on the other side of that cycle where rates are coming down. That should be good for the bond prices.
Great. Yeah. I mean, the traditional portfolio builds of using stocks and bonds for offsetting, using bonds to offset stock market risk, is something we've talked about in depth, and you guys have some other programs out there that can help that with clients. And I think we're going to touch on that a little bit later. So,
Yep, there's stuff that back to the conference you talked about. The key speakers were Brian Belsky and Jeff Sherman, and a couple other ones are fantastic. But a lot of focus is on like structured notes and ETFs and some of these portfolios that we that offer downside protection, but also give you upside participation in the overall market. And you do guys, you do a fantastic job with your clients. I know a lot of your clients own a lot of these, and they're great, right? You give up some of the upside by having some of that downside protection. That's kind of where you're talking about those, traditional 60-40 portfolio. Maybe 60-40 isn't the right answer for some of your clients. Maybe it's going to be, 60% stocks, 30% in bonds, and then 10% in kind of these structured alternatives, which I think
Yep.
is give you some great upside participation.
Great. So let's talk about an asset class that we don't, that's kind of new out there. We got to hear from Anthony Scaramucci, and his take on investing in crypto. And we get that question from clients often. So where does Gradient Investments stand on crypto? And if we have clients that want to get in on it, is there ways for our clients to get into that type of asset class?
Yeah, that's a great question. That was another, like I said, our lineup was so stacked. I forgot to even mention Scaramucci was also there as well. So he's kind of known as one of the Bitcoin kings, original guys. So he came on the presentation, and obviously that's his background. He's very bullish on Bitcoin, so not a surprise, right? That's kind of his background, and we like Bitcoin as well. But you just want to make sure you have it in a reasonable allocation within your overall portfolios. And he mentioned, the guy that's super bullish on Bitcoin mentioned it should be about 3 to 5% of your overall allocation. That's kind of where we're at as well. And we have a portfolio, like you mentioned, that also captures the ability to participate with Bitcoin through ETFs. And that's our digital discovery portfolio. So that portfolio is going to have about 10% of that portfolio is exposed directly to Bitcoin ETFs. So we own a couple of those within that portfolio, and it's got about 30% of that overall portfolio has exposure to Bitcoin, our mining, different like Coinbase and a few other things in there as well. ETFs that participate outside of the direct ETF exposure in Bitcoin. And the other part of that portfolio, it's got exposure to artificial intelligence, blockchain, metaverse. So this is a very aggressive portfolio. When you look to the future, kind of like Bitcoin, it's still uncertain. That's why, 3 to 5% makes it significant enough that if it really moves like it has, it's volatile. Like right now, I just look, the price of Bitcoin is 67,000. We go back a year ago, it was only like at 28,000. So it's, it can move in 100% up movements, but that means you can also get that correction where it's down 50%. I just mentioned that's 67,000 right now, whereas just a few weeks ago we're at 53,000. So it's just make sure you size it appropriately for your overall position in your allocation, because it's volatile, and you don't want to be buying at the high and all of a sudden the market draws down and all of a sudden you're down 30-40% of that portfolio, and then by the way, that was a 50% allocation of my clients'
Right.
money. So just be careful with it. We are believers in it, but we want to size it appropriately, and just make sure that, again, to participate, the best portfolio we have is to be the digital discovery. And I like that portfolio because it's also got other stuff, metaverse. You've heard about the investing there going on with the old Facebook company that changes their name to Metaverse. But there's other names as well. And blockchain is a technology that a lot of your clients may not be familiar with, but that's like banking stuff, that's security that's done, in a technology. It's called blockchain. So it's got more than just crypto exposure.
Okay. And we had Mike on here a couple weeks ago talking about that portfolio as well. And, I think like a lot of our clients, he mentioned about being old school and kind of coming around to it slowly. So, I definitely think, if we have clients start looking for it, they would definitely be keeping it in that 3 to 5%, part of their portfolio. So,
Yeah, his opinion. He's a little older than I am, not much, but I'm in the same. Him and I, unfortunately, are a little more old school, So it's just be careful with it, but it's done fabulously well over the last several years. So if you do want participation, just make sure you size it appropriately.
all right. Great. And I mean, you touched a bit on AI there, which is on a lot of people's, seems to be a big subject right now. But something else that's on everyone's mind that's coming up here in about 3 weeks is the election. And our clients are worried about what that means for their accounts. So, um, you know, before we get into the election, depending on how that goes, we might see some changes in the tax code with the Tax Cut and Jobs Act, or the Trump Tax Act, that's set to expire at the end of next year. So, do you feel that there's any impact on the market based on those changing tax laws that we need to be on the lookout for?
Yeah, that's the one thing I think that's a little bit underappreciated by the overall market and pundits on TV talking about, what's going on in the market. Again, we're bullish going forward. Unemployment's good, GDP growth rate's good, earnings next year are supposed to grow 15%. That's great. We don't even if it grows 10, that's good enough for a tailwind, we believe, for the stock market. So again, 15% would be fantastic. But the one thing that no one really, obviously, the one negative that everybody usually talks about is the valuation of the overall market. And again, we agree it's on the high end of the market. So that's why it's too hard to get super bullish, because valuation is not going to push the markets much higher. It's going to have to be company earnings, which we do think they're going to grow, and that will push the market higher. But the one thing people aren't talking about, and you nail it, it's a great question, is taxes. And they are sunsetting next year, regardless of what happens in the election. Republicans or Democrats, if nothing gets changed, those are going to sunset. And so the problem is it's not like it won't be a big shock to the system. But what's going to end up happening, since corporate and individual tax rates are going to go up, taxes are a tax on consumers, right? So you have less money in your pocket to spend. And I'm of the firm believer, I say it almost on every video, is when consumers are working, they have money in their pockets, they will spend. That's just the U.S. consumer. They love to spend. So the problem with taxes going up, they're just going to have less money to spend, which drives the overall economy. So that could be a slight headwind that no one's really talking about. And the other thing is on corporate tax rates. If that goes up as well, that's just going to make us a little less competitive in the overall world environment that we compete in. So that could be a little bit of a headwind for those companies. Again, not a huge, but this is something that, if those are two slight headwinds, both consumer and corporate, I think the valuation, that 21 times multiple is mentioned on the PE multiple on the S&P 500, that could come down just because of things aren't all rosy, and that goes to 19 times. So that's going to be a little bit of a headwind to the market. On top of that, like I said, if consumers are spending less, corporations maybe have a little less capex or holding back, that's going to probably be a little less earnings. So you would have not only your multiple coming down in the overall market, but then I think your earnings would come down a little bit more in your market, which that could cause that be that air pocket in the market where we kind of have to go through an adjustment period. Again, companies that get through it, they'll adjust, but I don't think that's appreciated. And obviously depends on what happens in the election coming up. That will help at least give you some insight to what possibly could happen. But still, you're not going to know yet. If nothing happens, they are going up. So that's something definitely to keep on the radar, and it's very important for people to understand.
Great. And finally, we'll kind of wrap up with this. You guys put most of your speakers on the spot there about what they thought was going to happen in the election. We're not going to do that to you today, but with the markets at all time high, and when you combine that with the uncertainties from the election, and so many other factors, the war in the Middle East and what's going on there, that can affect market volatility. I think we've touched on this pretty well, but just to kind of wrap it up, where do you guys see the market headed the next 12 to 18 months? And is there any other concerns out there that maybe our consumers aren't aware of that could affect your predictions?
No, we'll start with the concerns you just mentioned. My concern, that again, I don't think people are talking about it enough, is the tax situation. That's a great question you ask. I think people need to be aware about it, at least understand what could happen even if nothing happens in an election, right? Election's going to be noisy. We always tell, one thing I'll caveat before I give my prediction is, keep your political views separate from your investment decision. Doesn't matter if your guy or gal wins or loses. Do not pull your money out if your party didn't win and put it all back in, think that's going to all roses if your party does win, because markets generally go up over time regardless of who's in charge. Obviously, our best case scenario is we like to see gridlock. That's what investors generally like to see, whether it's Republican on top and a mixed Senate and House, or vice versa, Democrat on top and a mixed Senate and House, because then nothing gets done, which, sad as it sounds, that's actually a good thing from an investment standpoint.
Right.
Other than this tax thing, that I think they need to work on that. But that's the one concern. Now, big picture, where do we think the market's going? I mentioned last year we were up 25%. This year we're up 22%. I think next year the fundamentals are in place, which I talked about, with unemployment low at 4.1%. Again, consumers have money in their pocket. They will spend. That's going to drive the economy forward. Earnings are really good at 15%. That's really high. I mean, normally it's, if you get, that 5 to 8 is really good. So if
Hmm.
you're at 15, that's twice, what we consider a really good year. So say we even cut down to 10, that's a tailwind. GDP growth rate they're expecting. Remember all the talk about recession about a year and a half ago? There was
Yeah.
no recession, and luckily we didn't buy into that, because again, people were working, economy was good. We didn't see it coming, and it hasn't come. At some point in time, we will get a recession. They're normal, but we don't think that's in the cards for the next 12 months as well. So GDP is anywhere between that 2.5% and 3%. That's a healthy backdrop. So that all combined are the two gating factors would be valuation. I don't think we'll see multiple expansion anymore. So I think we're at the high end. So you put this all together, throw in a basket. What does this mean? I think we get more of a normalized earnings kind of returns for the S&P 500 for the next year, 18 months. So that you can kind of think of that 7. Again, you're throwing darts when you're trying to fine point the prediction. But I would say it's going to be more that normalized return of that 7 to 10%. But again, if we went 25, 22, 7 to 10, I think most people would be pretty happy. I don't foresee, anything could happen, but if fundamentals hold in like they are, I can see the market continue to move higher. Now, taxes is a consideration. The election will be noisy, so we'll see how that plays out. That could impact things again. So that's our general take, is we think we'll have a more normalized return. I think we pulled some of these good numbers forward, and that's why we've seen such a strong year. I don't think anybody's predicting a 20-some%, first 9 months of the year for the overall market, right? That's a big start to the year. And now we're closing. Seasonally, we're going into the strongest part of the year. Q4 is seasonally a good time to be in. Usually after the elections, also usually a kicker in election years as well. So history's on our side that we at least squeeze out a little more profits or gains this year yet, and then we'll see what happens next year.
Awesome. Well, that's all the questions we had today. So Keith, we thank you for your time and for taking the time to try to educate our clients a little bit more, and chance for our clients to get to meet other faces at Gradient that are responsible for some of the decisions where they have their money at. So we thank you for your time today.
Thanks for having us. We love working with you guys.
That's been a great partnership. We look forward to continuing it.
Thank you.